Hi, welcome. It's Michael here. We're going to be diving into the competitive edge intelligence briefing for November. So let me just flick my camera over and then join me. Great, and welcome. So we're going to be covering off the competitive deal playbook, the cloud edition. So this is just focused on hyperscalers and also challengers in this particular industry segment. So the data sources we've used to compile the full report are basically from verified proposal data, enterprise buyer feedback, and then also analyst validated pricing benchmarks. So this is the executive summary for November 2025. If you want the full report, just click on the link on the description. That will take you to the full report that you can download for free, something that we do every month. But there's a lot of interesting stuff to go through in the November summary. So essentially, we're seeing three key trends. Number one is credit leverage as a margin buffer and a deal sweetener. And basically what we're seeing is hyperscalers and challengers alike are increasingly using consumption credits, migration credits, and also partner funding as a way to offset margin pressure and inch deals over the line. So these credits often mask hidden discounts while preserving headline list prices. So essentially what we're seeing is that hyperscalers are not wanting to reduce the list price and basically look at discounting. So then basically adding in credits instead. And those credits can then be used as a way to sweeten the deal to offset the pricing, but they don't lower the actual list price. So it's a real, basically, a fundamental thing to avoid basically margin compression from a list price point of view, and then essentially add in these sweeteners so that the buyers feel that they're actually getting something to inch over the line. The second thing we're seeing is bundling and sustainability offers as differentiation tools. So essentially providers are packaging ESG, green energy guarantees and carbon offsets, and also sustainability linked SLAs as add-on bundles, which is quite an interesting play. This is especially happening in public sector and then also European Union deals where the ESG initiatives of sustainability are far more important. So we're seeing basically this as a shift away to basically discuss price too much and then to bundle in other things that can be differentiated. Look at these other things you're actually getting from us, which is going to basically add further sweetness. So this is a pure play around bundling in more aspects around differentiation. And the third area is we're seeing term commitments. So hyperscalers are looking for term commitments, but there's also step down, what we'd call pricing escalators. So the classic move remains: get the commitment to a 3 to 5 year deal, but then get step discounts in years 2 and 3. So quite a clever play if you think about it. So still the focus is on getting the full term, but willingness to negotiate within the contract wall itself. And we're also seeing more hybrid commitment models. So you get the commit, but then as you're going through the contract as a buyer, you can then flex and what we would call get flex credits to reduce some of the buyer anxiety. Are they going to be locked into 3 to 5 years when basically there's other pricing moves going on in the market? So those are three very interesting things we're seeing in the month of November. And basically our overall view would be that cloud providers are weaponizing credits and sustainability bundles in order to offset margin compression. And basically these dynamics we feel are reflecting a deeper tension whereby providers, they want to maintain their list pricing. So this looks better to stabilize the market, also looks better for market optics, also for inter-supplier benchmarks, but also of course, winning deals and then putting those levers within the contract in order to win the deal. So, but buyers are getting more skeptical. We're seeing, and that is leading to rising demands for more transparency, more true usage-based resets, and then auditable pricing terms. So that basically wraps it up. If you want the full report, there's a lot more to go through. We haven't got the time to cover it here, but just click the link on the description and then get your full report. Thanks very much. See you on the next one. Cheers. Bye.